Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into some interesting dynamics in the market, kind of intense for certain industries. But we'll start with the idea that artificial intelligence has sort of injected a lot of change and honestly a lot of optimism around sort of efficiency gains, cost cutting, increases in productivity, and amplified output. So whether you're an individual being able to get things done more quickly and more substantively, or businesses where this can really translate to better processes, quality control, lower costs, maybe amplified revenues, and ultimately improved earnings. But as these new AI capabilities are being announced for specific industries, we're seeing really bouts of volatility across certain industries as investors are trying to understand the implications for sort of traditional businesses when sort of new capabilities are announced. So we've seen kind of significant weakness in areas like software, financial services, insurance, and legal research services. And so this is the topic I want to get into. And it obviously, when you see this kind of localized negative volatility, it sort of causes people to take a step back and kind of ask the question, what's going on with these companies, and what should we do about it, basically, as investors? And so let's kind of walk through it. I'd say starting with the market. So the bottom line here is that markets have been elevated, meaning that they've gone up a lot. So you'll hear the term richly valued. Analytically, a metric that's often used for that is the price-earnings ratio. So for the S&P 500, sits at 27.7 about, and that's 23.6% above its 10-year PE ratio average. So it's just one way of looking at rich valuations is how is that price-earnings ratio, PE ratio, sitting compared to its own history. And then another thing, there's an index, it's sort of a technical thing called the S&P 500 30-day realized dispersion index. Basically captures how wide a range we see in a way in stock returns. And that's jumped up a little bit to levels that we haven't seen since last April with that tariff scare and the volatility related to that. So little bits of signals saying, hey, there's a variety of performance happening in the index and a lot going on in terms of worries about these various industries. Now, when we get to the idea of impact, as an example, with software, we saw in the first 5 days of February, the software and services index from the S&P 500 segment falling close to 10%. We've seen various financial services, especially wealth management firms, falling 5 to 10% on really what was this sort of nuanced announcement about some tax planning software that has been created that includes AI. And then same kind of thing, an AI insurance comparison tool causing certain insurance brokerage shares to fall, round numbers 10%. And those are, big numbers. It's almost like this shock of people trying to figure out, oh my goodness, what's AI going to do to these companies? Now, I think one of the things that we're trying to unpack and we'll get into is this distinction between whether AI can be used to help workflows or whether AI is going to basically compete with and replace the whole business. And so another sort of item that has shaken things is Anthropic, a big AI company, has announced various agentic workplace tools. Think of it as vertical functions. Certain tools that can do certain things. And so that's shaken people to say, well, gosh, if that gets expansive, how much are certain businesses sort of being taken out of the equation? Now, what we've seen as a result, though, is that industries are sort of moving together. I would call it an AI risk basket, where prices seem to be falling, and one could quickly argue that this is falling at a level where many of the stocks are going below their fundamental value. This actually happened earlier in 2025 when there was an announcement of DeepSeek, basically this new AI model that was trained in a more cost-effective way. So, for example, NVIDIA and another company, Broadcom, both traded much lower, like moved down a lot in the wake of the fears of that news, but only to recover. And so, one of the things we're seeing, this is a little bit more widespread, different industries being affected and more names in a way being affected. But again, fundamentals matter. And so that's, in our view, the focus is sort of like there's a strong sense that this reaction is an overreaction. And so when it comes to things like how a company is in place, there's all kinds of sort of intricacies to this in the sense that that companies are sort of embedded in their client organizations. So, basically when you look at businesses where maybe the company's involved in sort of enterprise-related planning or CRM, client relationship management, HR, finance, or sort of capabilities involving lots of secure customer data that needs to be secured. Displacing services like that's going to be kind of hard. And so, that's one lens we're looking through is we're expecting that a lot of these stocks have fallen, but when you take that fundamental look at sort of their business model and how ingrained they are in businesses, then, we'll see hopefully some recovery because it's hard to displace them, basically. Now, there are some factors that are affecting some businesses, especially those that have their revenue model be a per seat charge, meaning every time a human being uses a service, they get a monthly fee basically for that. And the one thing we know about AI is it seems like very quickly we're seeing a slowdown in hiring. So fewer new seats getting created. So that's a little bit of a headwind on that revenue. And so what we will expect is for those companies to evolve their revenue model to be different. And so it could be more about the capacity that's used, especially if they start layering in AI capabilities. They can charge almost like for the workload, how much AI are you using? And so think more in terms of outcomes and capacity that's being used, and that those companies may evolve their revenue model accordingly. And until they do, if they're going to stick with a seat charge and there's fewer seats being sold, then that is a fair issue to wrestle with. And, obviously if that happens and there's increased costs, let's say, to try to deploy AI, we could see a compression of margins, profits and earnings as it relates to that. Now, overall, what I would say is there's another phrase that's been out there, which is it seems like we're in an environment where it's sell now, ask questions later, and not be focused on the fundamentals. We often use the phrase stay the course when you're investing and you see some volatility. In this case, I think it's also stay the course on process. What do we mean by that? Well, a robust investment process looks past the fears to the fundamentals, right? So you have to unpack what's going on with each individual company. In this case, try to assess whether AI is a friend or a foe. Is it going to help them improve their business, or is AI going to take over and compete with them and beat them out for business? And that has to be done sort of business line by business line, company by company. But we believe pretty firmly that these sell-offs are a bit overdone, and that while there will be some losers, if you will, some companies that really truly deserve to be sort of lower value, generally speaking, fundamentals will come back and we'll see some recovery. So that's really what we wanted to cover. It's sort of a was a bit of a complex topic, and it's sort of spread around. It started in some ways, I think, with software, but it spread around to different segments, different industries, and it's a pattern probably that we're going to see repeat itself. But ultimately, what will be important to note is whether the fundamentals kind of come back into focus and we see some stabilization and recovery, but we just have to be ready for different bouts of sort of localized industry volatility as AI capabilities get announced and investors start to understand what the implications might be, and then do the work, assess whether specific investments they have are good. And the way I think about it is you do the work, right? You make a judgment about that future, and you really have to make one of three decisions, and you want to try to do it with conviction. One is to establish or expand a position if you think the selling's overdone. The second is, hey, even though this might be a valuation reset of sorts, hold the position because the fundamentals are good. Or you make the judgment, hey, I think there's trouble in the future, and I really should exit the position. But it isn't a sell now, question later approach. It's more do the work and make a judgment, and then sometimes you're selling in the current environment. So again, a little bit of an involved topic. I hope it's helpful. Appreciate you taking the time to listen to this episode, and we'll catch you on the next one. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.